even those they've been public in the last 2, 3 years, many have shown zero profit. I've not seen any path to profitability. And when the market turns, when the Fed starts taking away the punch bowl, then they get hit pretty hard, as we are seeing.
On this episode of Early Bird, Arvind Venn, founder and CEO at Capital V Group. Arvind joins us today to talk about why technology sector stocks are performing so poorly in 2022 and what investors should keep an eye on. If you're an investor looking to stay on top of the latest market trends, then you're listening to the right podcast. This is Early Bird, and I'm your host, Stephen Lerner. Before we get to today's discussion, let me tell you how you can save time and beat the market through Early Bird, a free daily email newsletter featuring commentary about the latest trends in stocks, cryptocurrency, and equity crowdfunding. Early Bird is designed to help individual and non-professional investors stay on top of all of the critical investing trends. The newsletter is 100% free and is sent to your email box each weekday morning. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, today's discussion. All right, Arvind, thank you so much for joining us today on the Early Bird podcast. How are you doing?
Very good, Stephen. Thank you for having me on today.
Well, thank you for coming on today's show. I'm excited. We're going to be talking about the technology sector. It's a sector that a lot of retail investors are heavily invested in. But before we talk about that, Arvind, let's talk a little bit about your background. If you could give the audience a short 30-second, Reader's Digest version of your biography, that would be great.
Let me do my best to give you a very brief thumbnail here. Thank you. So my name is Arvind Venn. I'm the CEO and founder of Capital V Group here in Cupertino, California. We are a registered investment advisory firm. I am an independent advisor, also affiliated with LPL Financial, the nation's largest independent broker-dealer. My background is I was in the tech industry for a while, initially as an engineer, then as a corporate finance and M&A person after my MBA from MIT Sloan. And I enjoy what I do in personal finance as an independent advisor. So the move from corporate finance to personal finance was fairly seamless, I would say. And I enjoy doing what I do, helping my clients help them towards attaining their financial and retirement goals.
Nice.
And I'm here in sunny Cupertino, California, not too far from the Apple Spaceship campus. If that
it's a good place to be. And yeah, I know, Arvind, you have a background in technology, which working in the tech industry, which is great because that's what we're talking about today is tech, the sector as a whole. It's probably been the most disappointing sector this year, at least for many investors. Why has it been such a bad year for technology sector as a general in the stock market?
Well, I could just keep talking about it, but I'll start by giving a brief answer. So I'll go back to Alan Greenspan's comment about irrational exuberance. I think it was late 90s before the dot-com bust happened. I've been watching the last 2 years, and I was shocked personally as an advisor and a finance person to see the stock market gains post-COVID. And sometimes it just didn't make sense to me because this just doesn't make sense. Some companies were not making any kind of revenue. They were work from home was a reason, but the valuations just seemed stratospherically high. And I think we are what in finance what we call reverting to the mean, where it's coming back, or another way to put that would be coming back to reality. The other answers would be that when the Fed was also partly responsible, given the very easy monetary policy, almost the historically low 0% interest rates that stayed for so long, that lowered the cost of borrowing, especially corporations. So now that regime, that story has ended with the rates going a lot more.
Yep.
The stocks that get, or the sector that gets impacted are those what I call growth, which is generally technology, which have high growth. where the cost of borrowing is lower, if the rates are lower. So when the rates start going up, they start getting hit harder simply because just to look at the movement of money, if the 10-year treasury is giving you 3.75% risk-free, then the riskier assets, the rate of return, they have to, what do you call, perform much better. So I think that's what we're seeing right now in terms of stock, the disappointing sector. And finally, and frankly, I think the valuations were really stretched. And when valuations are really high, every quarter, whatever the company may be, whatever the FANG or whatever, they can't stumble. The moment even if they are highly profitable, but if they don't meet the quarterly estimates, they get clobbered. And I think that's what happened.
So it's a mixture of the valuations being way too high, interest rates as well. You think so? Those seem to be the big factors why the tech sector has not performed well.
And the expectations too. Yeah, the expectations were high, and the moment they stumble, the earnings even miss by a bit. Then they have the high price to earning ratios, P ratios, all that were combining factors.
Yeah, I mean these tech stocks have it's been awful for so many investors this year. I want to talk about some of the other reasons. I know you mentioned, interest rates. So it sounds like inflation is having a somewhat of an issue in the tech sector. Maybe I'm wrong. If inflation is having an issue in the tech sector, why is it? Well, I guess first two parts. Why is it impacting the tech sector first, Arvind? Do you think it is or no?
Well, the inflation, as I mentioned before, in terms of interest rates, so rates go up when the inflation rate goes up. So if I could get, or anyone could get a decent enough risk-free rate of return from a treasury bond backed by the U.S. government, while the rate of return is marginally higher for a much riskier asset. So that itself makes people think twice, right? So that would be one reason. So inflation, definitely the higher rates do matter. And secondly, in terms of cost of borrowing, also goes up significantly.
Got it. So I guess since inflation is playing an issue, it just feels like tech stocks are being hit harder than some of the other sectors, namely healthcare, retail, utilities. It just feels like technology, especially information technology, is just being hit harder. Maybe not necessarily harder, but it just feels like it's getting punished more. Do you sense that as well?
I do see that. And I think sometimes there's a reason for that too. When you look at the overall price to earnings ratios in terms of we step back. In certain other sectors, more mature companies, they have free cash flow. There's so many metrics that we evaluate in saying, okay, is this particular company or stock, are they richly valued? Are they fairly valued? There's no crystal ball in how they'll perform, but we can do a lot of analysis, technical analysis, and to see how they are valued and what their forward P looks like. In many tech stocks, many of them are loss making, right? So they're many of them, I won't name them, but many have, even those they've been public in the last 2-3 years, many have shown zero profit. I've not seen any path to profitability. And when the market turns, when the Fed starts taking away the punch bowl, then they get hit pretty hard, as we are seeing.
I see that. So one of the other big trends, Arvind, the past few weeks, a lot of tech companies, both public and private startups, a lot of tech companies are announcing layoffs. It's sad. It's sad for those workers. Is this a trend in the tech sector? This new rise of layoffs, is this a trend that should scare investors away from the sector?
I think, generally speaking, every company, you have to do your research and see if it fits with your investment philosophy and risk profile. But talking about the topic of layoffs, Silicon Valley or the tech sector is known to hire fast and fire fast. We have seen that happen in 2002, the dot-com era, in 2008. So I think hiring was was pretty aggressive. Because they had very aggressive growth goals. So when the growth goals don't happen, then they have a huge expense in terms of payroll. So what we are seeing now is that because the numbers aren't being met, they're just jettisoning people, which is very sad. Actually, the hiring always, I think, should be done properly with a good forecasting. But if in the case of, I would say, privately funded companies, venture capitalists, sometimes if they have growth at all costs or at any cost, they're going to hire a lot of people, and there's a lot of competition for talent because they had to hire people, so they hired at very high salaries. So I think all that is coming back when the market takes a turn, then you see that layoffs happen. So it's possible that there could be more layoffs, but it does not mean that the good companies with good balance sheets and good prospects and good cash flow, even though they are probably taking a hit along with the overall market, it's quite possible that companies that are well managed in terms of all those metrics, they should definitely do well over the longer term.
Good to know. When we return, we'll hear from Arvind about specific sectors in tech and how the average investor should approach the tech sector for the rest of 2022. But first, let me tell you how you can become a more informed investor through Earlybird, a free daily email newsletter. Earlybird has commentary on the latest events and trends in stocks, cryptocurrency, and crowdfunding. With Earlybird's daily weekday email, investors can quickly stay on top of the trends and beat the market. Subscribe to Earlybird for free at www.earlybird.email. Once again, that's earlybird.email. And now, back to today's discussion. So, Arvind, today we're talking about the technology sector. This is a sector that, for many investors, it's been a terrible year so far. Let's kind of break down the sector a little bit. As you know, within technology, there are several subsectors. You can categorize different technology companies by each of these sort of subsectors. Let's kind of go through them briefly. Fintech, still one of the big ones out there. Financial technology is not going away anytime soon. Well, what's the current state of fintech right now?
So there are the larger companies, as you know, the established ones that are credit card companies. So they are also moving to technology. There are you have companies like PayPal and Square who have different technology, different technology for payment, and you see many other new innovations coming in. So I would think that the fintech sector overall for the established companies, and there are some companies that are private that are also doing quite well, and be engaging with some top-notch companies, they will continue to do well. Now, having said that, again, in this sector, I think the valuations, again, are very high. If you look at some of the companies, the top prices where they went into 2021 in their peak, many are down 50, 60%. These are all, I would say, still good companies with good business models and good technologies, but they're clobbered, south of 50%. So I would say that there is promise in the sector for sure. And once the excesses are cleaned out, and as they start having reasonable expectations and they deliver to that and meet or exceed those, these companies should have a good future ahead. Now, I'll also mention there's also real estate tech. I think many companies are in the real estate side where for online mortgage approval, things like that. Yep. That sector, I think, will get hit harder because when rates are going up, the buyers will be less people will be doing refinancing, less people signing for mortgages. So if they've hired a lot of people in that sector, then I think there's going to be definitely more pain in that sector until the economy stabilizes or the market stabilizes.
It's good to see that. Fintech definitely exciting, but I think you're right. Real estate tech could be hit. Another subsector I do want to just talk a little bit about is cybersecurity. There's still a lot of hacks going on out there, and cybersecurity companies are very strong right now. What do you make of that group of the cybersecurity companies out there?
I think that's a great sector. A lot of our lives are moving online or already have moved online. So I think that sector overall has a lot of promise. And with more and more transactions going online, there are a lot of bad actors, both within or state sponsored, but from outside that are they find it very attractive to break into not only retail but also perhaps defense installations among others. So cybersecurity is going to be key and will only increase, I would think, given the amount of transactions going online every year and the massive number of transactions happening. So I think that's a sector. So in fact, I know even at LPL had spent, I don't know, 200 million or more just for technology. That obviously cybersecurity also is an important aspect where we do want to take a lot of effort in making sure that our clients' information and assets are safe. So I think that's something that's non-negotiable, and that's very, very important aspect. And I think there'll be a lot of spending in that sector, which in turn benefits companies or leading companies in that sector.
I see. So I can see the benefit of that for sure. And then lastly, like AI, cloud, what do you make of those tech companies out there who are in AI and cloud? Is that kind of a good place to be too?
I think cloud, as you already know, the bigger players. I mean, you already know with AWS among others, they're the leaders, but there are others catching up. So the larger companies, the cloud, the three leaders, they'll continue to grow because I think in terms of I don't mean to talk about the companies. I'm just talking about the cloud market segment. That'll continue to see good, healthy amount of growth because we have pretty much everything is going on the cloud, like right from your podcast, where you store your podcast, all that is cloud based. Like it's the platform that we're using to talk on this, so that's also going into the cloud. So pretty much that sector will continue to grow. I think that's now the question is, will it have the same rate of growth as before? Because as you know, adoption rates change as they get more mature. But I think it's definitely a good sector that's a bit more things going to the cloud. I think that you'll see growth in there. Talking about AI, there are different sections to that. But overall, I would say that AI has been around for more than 20 years, but it is seeing a lot more mainstream activity along with machine learning algorithms that are getting more popular. You'll see a lot more activity happening in different sectors, whether it be in the medical industry, whether it be in just voice activated certain technologies. Many are also self-learning, meaning the AI primarily is to get the machine to be more intelligent. So as it continues to transact and process millions and billions of operations, the machine learning algorithms that are inside definitely start making the machine more quote unquote intelligent. So based on the what I would call the application, some sectors may have more growth than the others, but overall it's an exciting technology to use. Like for example, it can also be used in fraud detection. So pretty much if you can do voice analysis, for example, or look at if the algorithm can say, okay, somebody's logging in from a different country, but they have not told the bank that they're traveling. Those are all could be applications of AI, for example.
It's used across the board, and you're right that this podcast is on the cloud. So Arvind, as we discussed, the tech sector has been awful so far. How should the average investor approach the technology sector for the rest of the year?
Well, great question. I wish we had a crystal ball to give you the answer, but I can based on what we're seeing in the market, the economy, we can look at certain trends that are happening. Like so, value stock or like the value segment, that is the larger, more mature companies that offer higher dividends. They have been trailing the growth sector for a while, but we see a sector rotation where people now understand the value of dividends, the value of being staying diversified. Even within technology, you have mature companies that don't have this high level of volatility or standard deviation as we call risk. So I think that certain growth companies who have been kind of beaten down, some of them have good business fundamentals, good cash flow. As and when the market starts recovering, they should also recover and grow, but at a more sustainable pace than the what I call the craziness of last year. The value sector continues to do well by just throwing the dividends and steady growth and steady business model. They could also be technology, but they may not be like the glamorous names, but they're also part of the technology sector, and they could also be a good differentiator or a diversification factor to lower the risk in the overall portfolio. And of course, a diversified portfolio, not just tech alone, has other mix and a mix of bonds too, depending on the person's age and risk profile. But overall, I think the growth stocks, some of them have good potential, and some I think they just went. I don't know why, maybe for whatever reason, they got into valuations that I personally don't think should have been that richly valued. Yeah. So those kind of stocks may have a lot of trouble regaining, if at all, their previous highs of last year.
Interesting. We'll see how that turns out for the tech sector the rest of this year. Arvind, thank you so much for coming on the Early Bird podcast and discussing technology, the technology sector, what it means for investors. Before we wrap up the podcast, I just have one final question for you, and it's the big question for today's discussion. That question for you, Arvind, is if you were in the Guinness Book of World Records, what would it be for?
That came from left field here, Stephen. But let me think about it. But overall, I think we don't. So as an advisor, we don't go about trying to tell people that we want to be in the Guinness Book to get the highest returns. But at the end of the day, we just try to make the best. We try to safeguard and meet their expectations. So, but we're talking about personally, or we're just
personally?
Personally, no. I don't know. I would say we've gone to the most number of countries in the world. I've been to 35 so far. I was telling my son, I have a 10-year-old son, and we were looking at the atlas together. And I told him, Grandpa wanted to drive from Paris to Singapore, and I said we talked about it. We never did that. I said maybe you and I can do that someday. So
would be an interesting trip. Yeah.
So we said there are 195 countries in the world, so maybe we can do 100. That would be awesome.
Yes.
I don't know if that will make it to the Guinness Book of World Records, but hey, it's that'll be somewhere along the way.
Thank you again to Arvind Venn for sharing your insights on the tech sector. And thank you to everyone for listening to today's discussion. We'll be back next week for another episode of Early Bird. Have a great day.